All right. We are live. Let's go. So today, episode number 2, hopefully fixed a lot of the audio and video issues that we had first episode. And we're going to be deep diving the markets as usual. So we'll start top down today and explore each of the major asset classes and obviously spend a bit of time in Bitcoin in particular. Look at some individual assets, equities as well, and just see what's going on in the market today. So we got our AI dashboard up here. I'll share that. This is aggregating all our data across multiple markets, and this is kind of the net position. Now, most of the time I agree with this take, but not always. So what we see today is obviously equity is bearish, Bitcoin it's saying is bearish. Important to keep in mind is how big each of those components is. So if it's within 5%, it's basically neutral. So right now, we're just slightly bearish, slightly bullish. So in each of these. So that on net, that's really kind of a net neutral position or not far off it. So it's not saying like take a short position or something like that if you're trying to interpret it. If you want to understand how it got that view, you can obviously click into each and read the top 3 metrics and the overall outlook. But generally speaking, we have a lot of positive long-term data across macro and Bitcoin. A lot of deep value metrics across Bitcoin in particular. But that is also being clouded by a lot of the short-term things we're seeing. In particular, of course, is the Iran war. So it's probably worth just diving into that for a minute. If we just look at the technicals for Bitcoin and do a really high time frame chart here. On the monthly, it doesn't look too bad. That 66 would be sort of a measured support, but we did get a failed breakout on the weekly of this pretty key level at 71.5K. So when you put that together, that tells me in the nearer term, probably the weekly is a bit more important here. But it's not a really strong sell signal, if you will. But you know, the breakout that we had was invalidated very quickly. And the reason really is because the Iran war is extending and drawing out longer than the original planned 4 weeks that Trump obviously proposed. And because primarily oil has been going through the roof, and that's impacting a lot of countries, and that results in risk-off behavior. So if we kind of look at that for a minute, some of the metrics we talked about last time were VIX, and I said if they get over 30 or if oil gets over 100, we should probably be a bit concerned in the near term. So 30 is really a historically key level for really a dip buying opportunity. And when you get into that, you're kind of in this high volatile area where a lot of different opportunities can appear long term, but in the near term, it's ultra volatile, obviously, because the VIX is going up. But so I like to identify opportunities when the VIX is broken out, but then it started to come back down. So it looked like we might have had that last time we streamed almost 2 weeks ago when we breached above 30 and then came back down, but we pretty quickly went back above again, unfortunately. So if we just look at the S&P 500 first, we've seen this kind of chart before, but VIX and oil are probably the 2 most important data points for world economies at the moment. So it's probably worth spending some time on again. Yeah, obviously all major dips that we have are when the VIX breaks out. So that is in theory, a long-term opportunity. It's just, how long does that go on for? Obviously, you can get events like 2008 where it's really big. I'm not suggesting that's the case now, but it just, generally speaking, the risk-adjusted opportunity, even though you miss out on some returns, is probably better when you're back below 30. You obviously won't time the exact bottom, but you'll miss out on any kind of major down draws when you close beyond it. So it looks like we had that, but we obviously have just broken back above it, on the daily at least. Again, could be short-lived, but there's a key sort of story I'm going to get to here, is that we're basically at the whims of Donald Trump at the moment. Even within the last 24 hours, we saw a pretty good rally a low time frame rally in Bitcoin and equities. They were up almost 1% or 1.5%, I believe, in the last day, because it sounded like he was saying that the war would end. So that was pretty quickly reversed with a lot of the more recent messaging about taking out all of their power, oil, and other infrastructure, and taking Carg Island and the Strait and all those other things. So the messaging is changing day to day as they theoretically negotiate, but I don't think it's going to end anytime soon, because the damage that's been done will take months and years to repair. In particular, the oil infrastructure, it's believed is about 30-40% has already been taken out of action. So that will take at least months and probably several years at the best case to be fixed. So yeah, as long as we're above 30, it's kind of like a cautious zone, but also long-term probably opportunity. If you're positioning in equities. Let's take a look at oil. If you're in the last stream, or if you've seen my other podcasts and things, you'll know that I said the $100 level is pretty key. We are actually above it, I believe. Yeah, we're at 105. So this is daily data. Is almost, it's going to update probably in a couple hours. So I'll just pull up TradingView for this one. We're going to make our data a bit more real time soon. So we won't have to jump around as much. But yeah, we are well above 100 now, 105. And it looks like a nice retest as well, if you're looking at the technical side of it. But yeah, you can just quickly eyeball this and know that a lot of big drawdowns and headwinds occur with many markets when you are seeing acceleration in oil. Acceleration being like extended periods of high returns, so like multiple months, double-digit returns in oil, but also just high elevated levels, like over 100 here. So yeah, so the 100 is kind of like also a psychological level. You're at triple-digit oil. It has an impact on people. Round numbers and psychological levels matter in markets, because people will manage their portfolio around it. So that's kind of a risk-off headwind there. Just back to our dashboard and what it's saying. Just looking at the chat here. Thank you, Gabrielle. Appreciate the feedback. And Bender. Cheers, guys. Any questions, just drop in and I'll answer when I can. So what do we got? S&P 500 presents stark divergence between headwinds, bearish forces dominate, driven by high gold to stock ratio. So that continues. We'll talk about gold soon. Contracting US liquidity. That's not good. That's an interesting point. So US liquidity, that's the money that's basically entering the markets at the government Fed level, and it flows downstream and obviously usually helps risk markets. One of the big things about oil is that there's, the market's now pricing in no rate cuts because high oil prices increases inflation, and we're actually now more at risk of a tighter Fed into the future, though I think that risk is being a little bit overblown today, because they can't get too tight if all of these asset prices going up and you have structural economic impacts across the markets. You're going to have higher unemployment, and we already have unemployment at a pretty concerning trigger point. So I'm not too concerned about that right now, the Fed tightening too much, but the whole scenario of easing and multiple rate cuts that everyone was pricing in is basically off the table at this point unless we get a surprise into this war, hopefully, fingers crossed. But right now, that's the environment we're in. Obviously got elevated PE ratios across a number of big tech plays, fear and greed. So a lot of sentiment data is actually plunged to extremes. So that's really positive. Probably suggests we're nearer the bottom than the top, just as VIX does being over 30. And then some other neutral factors here. So gold to stock, fear and greed, and liquidity are probably the biggest ones. So we can look at each of those briefly. So the gold to stock ratio, there's not going to be a lot of news here. This is a ultra high time frame metric that will trend for years, really. We had a pullback in gold to 4,500. Obviously, the gold to stock ratio still pretty similar. So equities have come back a lot, and it's actually gone up in the last few weeks, or a few days, I should say. But yeah, pretty static there. And as long as this is red, it means that gold is outperforming equities across the 200-week moving average. And that is a pro-gold environment. That means that gold in those environments, it will typically last, as I've talked about many times before, it will typically last for 5 to 10 years on average. It doesn't have to, of course, it can be short-lived, but you'll see over the last century that these periods are typically 5 to 10 years. It's the 1930s, 1940s, 1970s, 2000s, and in each of them, in every single one, gold went up a lot. And from where we are now at 0.7, it went up to, in many cases, like here, 5 or 3. That means there's headway for a 2, 3, 4, 5x in gold against equities. And that doesn't mean gold just goes straight up. It could mean gold just goes sideways or even down and equities just goes down more. But none of those scenarios have to happen. It's just that it's a strong environment for gold as long as gold is outperforming. Obviously, we do have a bit of a, technically looking top here, you could argue. We've had huge vol in gold, comparable basically only with the 1970s and 80s in the recent 3 or 4 months. So that's, we kind of clipped quite a bit of gold exposure through that period, but not entirely. So there's still a strong case to hold some, in my opinion, for now. But the bullish case is a bit more diminished now that oil is very high, VIX is very high. So gold and Bitcoin too really tend to work better as insurance, but early insurance. What I mean by that is that people say, like 2021, people would talk about how we had inflation go up and Bitcoin maybe wasn't a very good inflation hedge in 2022. But the fact was that Bitcoin and gold saw it coming in 2020. Just pull up Bitcoin for a second. It was around, give or take, around here that all of the stimulatory inflation reactions happened. And Bitcoin then started to price that in straight away. But it didn't flow through into the economic data until about 2020 onwards here. 2021 onwards, sorry. So at this point, we kind of saw Bitcoin top and go down and inflation was still going up. And people were saying, oh, Bitcoin's not an inflation hedge. It is. It just, you have to time it right and have to be more early in that move. So that's kind of where gold was in the last 12, 24 months. We were extremely bullish on it, had relatively big position there. I still think it is going to do very well in this environment as long as the gold to stock ratio is red. But it's obviously, there's a lot more risk nearer term, and nearer term being multiple months, 6 months, even a year of measured pullbacks. We do have, if you want to, we could do some quick technicals here. A pretty nice retest there on a nice weekly level. There's no real monthly support, until 3.2K. So that, if we close below if we close below 4,250 here on a weekly, I mean, I wouldn't be surprised if we did a revisit lower. So you have to be pretty comfortable with a lot of vol in this kind of asset, or you have to manage your position size accordingly and downsize it, like we did in sort of Feb, March a little bit. I think, depending on where the war goes and what Trump says, there's a decent case that this level holds for a while, or we could just simply consolidate here for a while. So, you don't trade an asset which is whatever it is right now, 20 trillion, as like a FOMO get rich quick scheme. This is not something that's going to move. Sometimes it does move very quick, but you have to be willing to wait a long time, be patient with something like gold. Near term, we still, there's no breakdowns on the monthly yet that are measurable. Obviously, there's a big ugly candle, but we have to see more price action to see some kind of major breakdown. On the weekly, as long as we close above 42.50, I think that's decent. The trend is still intact, albeit it looks a bit ugly. So if we're kind of grinding down and spend time below, like I said, 42.50, then I'd probably get more concerned in the near term. So it's good to be near a sort of relative line in the sand. If you put it on the daily, we're just sitting above it right now. Those will know our work and our newsletters and things. If this is Bitcoin and you're grinding along a support, that is not usually good. The longer you spend there, the more at risk you are of a major move down. So that is something to consider. But yeah, that's gold. Otherwise, broadly bullish because the trend is largely intact and primarily because we're outperforming equities massively. And a few other factors here like global M2. We won't have time to go through every metric, but we'll skip through a few of them. Perhaps US liquidity, because I do like this one as an early warning sign for where things are going to go. I'll make my image smaller, so maybe I'm blocking up too much of the chart. All right, so yes, US liquidity. I mean, it has been coming up. When I look at this, it's not as bad as it sounds. It has been coming up since November as the markets go down. So I don't see that as necessarily bearish, to be honest. I mean, it could be much better looking, but it's not like trending down right here. So yeah, I'm not too worried about that. Basically, if you don't have a very clear picture on any metric, or it's kind of here or there, like this one in the middle, you're better off just ignoring it, to be honest, and just focusing on the signals that are more obvious. And oftentimes you don't have enough obvious signals. Like right now, as I said, we're pretty close to net bullish, net bearish matching on a few things here, and it changes day to day. In those scenarios, it's a low conviction environment, so you don't want to be going and taking big positions on anything. Fear and greed. Let's definitely look at the sentiment stuff. This is quite interesting. This is probably one of the more interesting indicators we're seeing at the moment. Fear and greed is really low at 10. This is the equities fear and greed. You can read about it. And this is really positive for risk assets, Bitcoin and equities. So I don't use the fear and greed for Bitcoin at all because I think it's useless. This is the only one that matters. And I've basically said that forever. But yeah, as long as you're in a green zone, there's some quite interesting dips. Some of them are short term, some of them more major. I mean, you can just pretty quickly see, some if you get in too early, right, you probably you can have more downside. So like everything, it's not going to time the bottom perfectly, but it captures a lot of dips, and most of them are pretty good midterm opportunities over multiple months and sometimes many years. So yeah, I mean, you can quickly eyeball there that the vast majority are very strong. Now, what I like to see with this sentiment stuff is because you can be in the bullish zone, if you will, for a long period of time. is confluence across many metrics, but also the more time spent, the better in those zones. Let's have a look at the others. Business outlook. This is the US manufacturer's expectation of the direction of change in overall business activity. So what, the people actually creating things that go downstream are seeing. They're pretty neutral. So, that's relatively positive in terms of, so their outlook is relatively positive, which is basically no signal in terms of investing. I guess that's probably not surprising because, they were pretty bearish in 2022, like everyone was in this big pullback. But since Trump came in, there's been a big drive for bringing manufacturing back into the US and all that sort of thing. So I think that has probably kind of kept things pretty buoyant. Anyway, no signal here. Active manager sentiment. This is the average exposure of US equities in US equities of active managers in the US. So it's come right back. It was really heavily exposed to the market at the end of 2025 when the market basically topped. So as always, when there's high exposure in the market, you're at greatest risk of a pullback. Again, you can see that pretty quickly. A lot of these tops here when that happens. But yeah, we come back. We're right near the green zone. We're not in the green zone yet, but combine that with fear and greed, and that's a positive kind of indicator. Again, it can mean we come down further, but we're having growing confluence here, which is good. So exposure has been trimmed a lot. So people have already de-risked in the last 2-3 months for a variety of reasons. So first it was like the AI wave of concern there, and then it was obviously the war. And then investor sentiment. We also right near the green zone. So we have a lot of sentiment things lining up. So really the market's looking for direction here. It's de-risked, it's concerned, it's fearful. That's not surprising. And we really need to know where this war is going and how long oil is going to be over $100 and how long the Strait will be closed and how long that's going to affect other economies. And the unfortunate answer is it's probably going to be longer than we expect, I think. Talked about before that wars generally counterintuitively are bullish for markets when they first start, but the difference here is that we've knocked out massive oil supply chains globally. I'm an Australian, and in Australia there's like 600 gas stations which are empty or something like that. It's changing day to day. There's been truck drivers stopped, so it's impacting supply chains and sort of things. So yeah, that's the big difference here. It's really a global impact from the oil, and the key metrics to watch are VIX and oil on that front. So what does that mean for Bitcoin? Like Bitcoin is still, like I said before, don't take this too seriously. If you read through, we have some really positive factors, sentiment, like we just talked about. We've talked about on-chain a lot. It's in deep valuation, undervaluation. So yeah, energy values 40% discounted still. Yardstick is at lowest levels still for a long time. Dynamic range MVT also in the green zone, come back up a bit. So that is quite interesting actually. It's pretty borderline on if it's in the value zone. Production cost is the reason I'm hesitant to be very bullish here because it keeps falling. It's at 57k and electrical cost is at 46k. That's not good. It's not required. Like we can bottom before it, production cost ticks up. So that's not critical. But as I've said, every bear market we have spent months within the production cost range. So we haven't even really touched it much at all yet. So that opens up the possibility of the 50Ks. I wouldn't be surprised if we didn't get lower, but it's really going to depend on a few things. The war, how risk off the market gets in the next 3, 6, 12 months. And over the next 1 or 2 years, how quickly we can tangibly address the quantum risk and actually build code to quantum-proof Bitcoin. That's the war and quantum is basically the only two factors that matter right here. I don't think we'll see all-time highs until the core team addresses quantum. They need to take some action on that. But the war and risk off is the only thing that really matters in the sort of call it next 1 to 2 months, and we'll see where it all goes from there. But yeah, valuation wise, if you're holding for the long term and you think those risks will be addressed, which often they are, and human ingenuity usually wins, we are in approximately a level of valuation that only occurs about 10 to 15% of the time. So if you're holding for 9 years, this is like a 1 year opportunity, if you will, because we usually only spend about a year in this sort of level of valuation on some metrics. Not all of them. So either way, like I think, if you're holding for 3-4 years, you probably can't go wrong, provided you trust that these issues will be solved. All of that said, every time we've got to levels like this, we've gone lower first. So I had a tweet about that recently. That was on the macro index here. So macro index is a nice aggregate on-chain strategy that sums everything up and basically builds a trend out of all of this. Is like 200 metrics basically. And every time we've gotten to levels where we are, which are, pretty rare, and these only happen about, as I said, 1 year in every 9, we've actually gone lower. So example would be here and also here. So again, it doesn't have to happen, but that's not promising. And it's only, a few data points. So I wouldn't take it too seriously, but you add all these factors together and the fact that we're still a long way above production cost, the fact we have treasury companies which are completely getting annihilated. So let's have a look at some treasury companies actually, because that's pretty also an important factor here. Where do we start? So I've talked about strategy a bit. Well, let's look at Metaplanet. We have 200 of these companies, which just doesn't make sense. There won't be 200 in 5 years. I guarantee it. I can't guarantee it, but that's my personal belief. They're all massively below their cost basis. So Metaplanet bought at 105K and Bitcoin's at 66. Like they're down huge. And then these are the better quality ones. Like these are the blue chips: MicroStrategy, Metaplanet, Mara. Mara's a good one. So they just recently nuked a massive part of their Bitcoin treasury. Like look at this, biggest sell ever, bigger than any buy they've ever made. Pushed their Bitcoin yield negative for the first time ever. The treasury model collapsing, right? Like what happened to only buy and grow your treasury? It just doesn't work. So they've only just hit their cost basis, and we do spend time below it as well. But the difference is back here we had whatever it was, 20 to 50 treasury companies, and now we have 200. Let's look at Strive, because the Strive team was giving me a hard time on Twitter today about performance. On their website, on their Twitter, it says they are focused on maximizing shareholder value. Well, this is the problem with the treasury model. They're down 96% in 6 months, or 9 months, sorry. 96%. So their shareholders are completely wrecked. Their Bitcoin buys at 103 and it's at 66 today. So they're down 36% on their buys. And if you annualize that, it's like 42%. So they're down 42% on their buys in 6 months, annualized. It's not a viable business model. So that we have a lot of, headwind from these treasury companies when price stays low. If we obviously bounce here, these guys will kick along and they'll kick the can down the road just like many zombie companies do. But the long term, there will be a consolidation and a flush here. That's just Bitcoin that'll end up hitting the market at some point, I believe. It's hard to imagine that going any other way, especially now the risk is even higher because of interest rates. So let's have a look at interest rates. Bond. Probably 10-year would have been better. This will do for now. When these treasury companies really did well, all of Michael Saylor's returns really, a lot of them were in 2020, 2021, and then obviously in this last bull market. But we have, rates of, let's get the 10-year in here. I think it's important. The 10 years is the only one that really matters. When we have huge spikes in rates, like here, and here, this is increasing the cost of capital for all of the equities and the relative rates of the opportunity cost for people looking at companies like Michael Saylor's strategy and treasury companies. Generally, higher rates are just bad for Bitcoin because you can choose, right? Do you park your asset in Bitcoin and get hopefully the historic yield, or do you park it in cash and get the 4 or 5% yields we have right now? So that's the trade-off. I think what we were looking at, call it 2 months ago, is that the Fed was forecast to drop rates to around 3% over the next 1 to 2 years. So that was like the forecast. Now I haven't even looked. We could just do Fed watch rates. And you'll see that like a lot of the odds of rate cuts have been stripped out. Yeah, so it's a 100% chance in April it will stay where we are. Let's look at the end of the year. Yeah, 80%. Basically, we're staying where we are. 80% plus where we are is pretty much guaranteed at this point. Before, that was very different. So this curve has really just gone up to something like that. Obviously, this is the 10-year, but it's pricing in higher rates, and there's even discussions of if there'll be rate rises, right? So there's a lot of uncertainty here now, which for the first time in really a couple of years, since they started cutting, it's been pretty clear they've been cutting for a few years now. But that's just kind of started to pivot into a gray zone. And so that's a headwind for all of these assets and companies until that changes, if it does. So it could change from unemployment rising, right? There's so many different triggers that can come out of this outside the war, from AI and all sorts of things. So we just need to keep monitoring the data. But right now, that's a headwind. I think I'll probably pause there on Bitcoin because I keep going forever, really. But it's a mixed basket. I'm not, very bearish on it. I'm not, I can see long-term value, but I can see risks as well. I can see this flipping bullish really quite quickly, potentially. But right now it's a mixed bag. So I kind of just want to wait and see. I want to see us above 71.5 on a technical front. Again, on a weekly. And it needs to be on more of like a back of the cuff Trump tweet or post like, oh yeah, we're going to end it, but then not end the war, or we're going to round it down. It has to be something pretty substantial, because otherwise we're pretty much just subject to Trump tweets and headlines at the moment, with probably a nearer term risk of more downside until we close back above 71. So you should be positioned for that, for downside risk until we're back above 71. So cash is good here, honestly, I think. And you don't miss out on much, right? Like if Bitcoin pumps up to 71 or 72K, what is that? You miss an 8% move maybe, to manage a lot of risk for if we were to go to production costs. It could be down that sort of level. It doesn't have to, like I said, but it's that risk reward opportunity, right? You can cut all that risk out and sleep better at night, and then just buy in a bit higher when that happens. Or you could just wait and buy much lower. So for me, it's kind of a cash is king scenario, to be honest, on that. That kind of holds across equities too, given the gold relative strength. I think equities there's some more opportunities there though. So we have this AI stock screener, which the good thing about equities is you have so many different sectors and industries, and there's always something benefiting at a different time. Whereas with crypto, if Bitcoin's down and the risk scenario, if Bitcoin looks bad, basically everything's screwed because the correlations are so high. So like right now, obviously we have a lot of strength in oil and gas. We've talked about this quite a bit. CVX was in the top of this screener for many weeks. It's still got a pretty good score of 78. That's not like a buy signal score, but I mean, I'm loving this screener, to be honest. Yeah, I mean, 15% or where it is around that level in the last few weeks is pretty awesome in this environment. Right now, the top of the market is BG. So you can read about all of that, why it got that score from the AI. And it's a agriculture and food business. I think that kind of makes sense as, we're seeing multiples really high in tech companies, and as all of the world is becoming more isolationist, manufacturing and agriculture and food supply chains in general, and bringing them home is valuable. So I like that kind of dynamic. It's completely different to something like Bitcoin and tech and AI. But I think there's some interesting components to that. You can also look at the revenue and profit margins, all that sort of stuff. I mean, revenue in the last year is up 75%, which is pretty epic. And just dive into it further with our AI chat if you want to ask questions. Tell me about BG ticker. Anyway, the more exciting thing is probably the technicals right now on this. There you go. So our AIs, you can choose any of the top models in the world, the best models in the world from all the top 3. And it's integrated with all our data. You can do fast or thinking mode, whatever you want. You can add files and things and chat. So it's really cool. I love it. Anyway, if we jump into, what am I doing? This chart. Yeah, it's a really nice looking chart. Monthly breakout, weekly retest and breakout again on the week. Provided this week closes above here, I mean, that's a beautiful chart. So yeah, and then, the AI gives targets and stops and things as well you can use if you want. Obviously, it's a guideline, right? This is the AI is crunching numbers on thousands of assets for us. And you can probably deep dive each one and refine it a bit further, but it's still pretty good. So what's the target at the moment? 178 on the weekly, and yeah, 160, 180-ish, depending on your time frame. That's looking at prior consolidations. So somewhere up there would make sense, right? And this is kind of like based on technical analysis where we have a consolidation here, and you can, this is very rough, but roughly a range there, right? And you got an equal move, measured move. So what is that? It takes you right to, give it, depending on where you put it, give or take, right? 160, 180K in that region. So that would make sense to me. All the macro stuff will impact this, of course. So if the war ends tomorrow and there's peace and oil production is at 100%, ultra unlikely, I think there's zero chance that happening. But if that happens, probably all of the oil and gas and maybe even assets like this will probably just collapse. But I mean, that's the good thing about these kind of charts is you're so close to invalidation, depending on how you want to define it. Like I would think the weekly level is a nice one there. You could just define as 124. So your downside is so capped, 3 or 4%, and your upside is 20%. So it's like a 5-to-1. What is the AI saying? What's the AI saying the risk reward is? Let's close this because I don't have enough space in this screen. 4 is the multiple on weekly. So it's been a bit more conservative in how it's defining the levels, but I mean, that's pretty good. I like anything above a score of 90 on here. I mean, 80s can be interesting, but you're better off just playing higher value setups. Sometimes there'll be, 5 or 10 or 20 in this 90 level. Sometimes they won't. And that's just kind of reflective of where the market's at. So yeah, we've integrated AI across pretty much everything we do. And we've got crypto scanners as well. No, obviously the crypto space is less interesting. I think 70 and below is not super exciting, but if you really want to trade in that space, you could explore some of those. But generally, for me, you want to play high conviction setups. And our AI-based Bitcoin strategy is currently basically in cash. I mean, short 0.04 is basically a cash position. So that's processing all the metrics through AI and taking trading, and that's some of the capital we've got on at the moment, and some of the return stats here versus Bitcoin. So yeah, long story short, crypto is really a cash is king world. Equities really for the most part, but there are some interesting plays in equities, which I quite like near term. And how long they're held and the opportunity they have will really depend on where this war goes. So you've got to be pretty dynamic here. And probably generally, of course, depends on your scenario, and that's not investment advice, but generally you want to probably size things based on your conviction. And given the fluidity of what's happening around the world, that is probably a bit more cash-based or lower position sizes. But anyway, that's just how I think about the markets. I'll just quickly see if we've got any other questions. All right, we have a couple. So I'll answer these and then I'll probably start to wrap up. Based on the work of Michael H., liquidity cycles have ended for now, and we can see that global liquidity index as well. Does it concern you? So I don't know who Michael H. is off the top of my head. I assume he's looking at something like global money supply. And the year-on-year growth rate in it. I mean, I need to see what chart you're referring to. But if I just look at this chart, which is the sum of all the money in the world, 117 trillion, it went up 11% last year. It has come back slightly from 118. I mean, for me, this is a very strong trend that's just going up. And I can't see it slowing because, I mean, I can from the point of view of inflation and, the war and stuff, but what are we going to get out of all that? Like near-term tightening maybe, if you're talking 6-12 months. But if we look beyond that, what's next? So if we tighten at all much more, and if AI continues to advance as quickly as it is, we're going to get massive unemployment. Costs of everything will be way higher because of oil, and people won't be spending as much. We can see that in also some of our macro multiples. So discretionary staples. So this is what people's spending on things for fun, basically, versus staples, which is things you need. That's a very dumbed down way of saying it, but it's basically collapsed. So that's not really good for risk assets because people are just getting more conservative, right? When we last year in April, we had a big bottom, it came down a lot, and it kind of came back with strength in this zone. This was a really positive sign because people were spending more, and the vibes were relatively better than the markets were suggesting. And then we had a lot of strength and the markets rallied. And then it kind of started to top out up here before the markets did. So this is a great metric. It collapsed before the markets did, very big risk sign. And now it's kind of, we're not sure, is it going to break down, or it looks like it might go another leg down, to be honest, but we'll find out. It could also just kind of be a bottoming thing, but either way, it's not strength, right? That is the opposite of strength right now. If we break out above here, that would probably be a good sign, but we're currently in a downtrend. So as long as that's the case, you're going to have some more economic concerns. You're going to have probably, people are, squeezing the belt a bit. So, it's with all the debt in the world, it's hard for me to think that the only way out of this is to not print. So I think that's why gold is in a massive uptrend as well. And I think Bitcoin, if it can solve its issues, will capture that bit as well. But yeah, let me know. You can tweet me the chart and I'll give a more detailed answer there. But right now, there's going to be obviously volatility in these kind of things, but I think it's going higher because it has to eat away the debt that we have in the world. When was the last time there was a downtrend in production and electrical costs? Good question. Let's have a look. It's been a while. So here we are. It's basically been coming down since October. So that's almost 6 months, 5 months. I would ignore this. So what happens is when there's a halving, the production cost basically spikes up because you get half the reward, and that kind of flushes out over a few months. So you could kind of ignore that and just simplify that line there. You always get that volatility in halvings. So, there's been sideways and choppy stuff. I wouldn't really count that as a downtrend. I think the last one is really 2022 and May 21. So if we just look at each of those, let's look at this one as well. Let's talk about all of these because they're probably the most interesting and relevant ones. So what happened here is in May 21, May, June, it's roughly in here, China banned mining, and they banned things a lot before, but they literally were crushing mining rigs. And that was like most of the world's mining was happening, and that just killed hash rates. And so this collapsed because the electrical cost is also hinged on the competition from the level of hash rates. And it just totally collapsed. And Bitcoin went down 50%, pretty much to match it. And then we bottomed and recovered. If you want to be bullish, you could. That's probably your best scenarios. You could say, "Oh, we're in something like that," because we're also down about 50%. But yeah, that's not where I land on this scenario today. We also had a lot of extremes here across. We didn't have any treasury companies except Sailor, so we didn't have that headwind. We had extremely negative funding for a long period of time, which squeezed the markets back up, and a few other factors. And it was really the first pullback in that cycle, whereas we've had like a lot of periods where buyers are just getting exhausted here, and that was also a rapid plunge, whereas this is kind of like a slow bleed out, and that's never healthy. It's a bit different there. At the other time is obviously 22. I think I talked about last time in my last stream and also in the last podcast I did. There's quite a bit of similarities here to today in terms of the level. You know, we touched production costs like we have done here. Similar level. We're holding up better today, I must admit. So that's possibly a positive, but again, grinding on support is not really healthy either. And then we had a huge minor collapse in 2018 when basically, you know, price just was down massively and 70%. And so profit margins were squeezed. People had already overinvested in mining, and then they started to just capitulate, and we had this big capitulation into production costs and then recovered. So look, there's no requirement that we go into production cost. But if you want a long-term incredible opportunity, it's usually in there. And that's what I've seen every cycle, every 2 to 3 years we get in there. If you ever touch electrical cost, I mean, that's just like the best opportunity ever for me. You know, we get close often. So, you know, here as well. But yeah, we're quite a long way away from it now. You know, 36%. So, I mean, miners are largely the ones that are still around and haven't pivoted to AI are very profitable. Yeah, I mean, price can recover, and then in that scenario, production cost can follow. So sometimes price leads, sometimes cost hash rate leads. It really depends on how severe the pull down is and on all the other extrinsic factors. But right now, this is telling us we've had a good pullback, which is good in terms of long-term opportunities, but we can definitely go lower. All right, what's next? I talked a lot about treasury companies, so I will probably not do that anymore today. Unless it's a specific question, you got a few seconds to ask it. Bitcoin dominance. Let me think about that one. What's your view on the QTUM equities as a longer term opportunity right now? Good question. So quantum has taken a beating as a very high risk asset class amidst a broader risk off in all markets. That's not really that surprising. So this is not super attractive right now. Yeah. I mean, this is an index of the top sort of 10 quantum companies. We could argue this is a bit of a support zone, to be honest. But I'm waiting for strength. Much like a lot of these metrics we talked about, unless it's super clear, I'm not interested. There's no signal. So we have a strong downtrend. We have a failed retest earlier, another one. So right now, I want to see some strength in it, which could mean lower first, or it could just mean higher first, but something has to change. That's a very quick and dirty analysis of our index. But you can do the same thing with QTUM and other assets. QTUM is different because it's basically a big tech. You're basically buying like NASDAQ 100, but to be honest. It's like, there's like 5 or 20% pure quantum. So I don't really think of it as a useful pure quantum index, whereas this is just pure quantum assets, and at least half all the activities are just quantum. Do you think STRC will impact this bear market depth? I mean, I have no real thoughts on STRC alone. Did you see Michael Saylor's AI video today? I mean, that was pretty hilarious. in a sad way. So this thing here, like AI video of living the dream through STRC. I mean, like, it just screams Ponzi, doesn't it? Like, I don't know. Like, they've financially engineered the crap out of this, and it's not working. Look at their cost basis. Like, you can't just keep buying something at the top with a hard asset and say you've got yield when it's a capped supply asset, and you're going to run out of yield at some point. I'll pull out the strategy chart again since people are obviously interested. Strategy is the healthiest treasury company of all because they started first, they have the biggest brand, they have the biggest ability to pull capital in. So I'm not like saying they're going to collapse or something. They already have in terms of price. What is it? So yeah, so it's down 80%. So you could have bought strategy, or you could just have bought Bitcoin and be down half as much. This business model, as it currently stands, to me, is not sustainable. Like, you can't. There's not 200 gold treasury companies. It doesn't make sense, right? Why would you have them? They're basically ETFs, but they market themselves as selling yield. But there's no yield. You are the yield. You give them money, and you hope that they'll be able to buy more and that other people will come after you and put more money in. So, like, it kind of is like a yield Ponzi, because it's a cap supply. If Bitcoin didn't have cap supply, maybe there'd be some pathway there. But I think what you'll see very quickly in the next 5 years, that's not very quick, I suppose, depends on your timeline, but all of these bigger players are going to turn to banks. MicroStrategy will start buying out all of the really crappy treasury companies. If you can get Bitcoin at 10% on the dollar or 20 cents on the dollar, wherever it may be, why wouldn't you buy it at an 80% discount? I mean, they say it's too much admin and legal now, but you set up a team to do it, get some people dedicated to it, and if you can get a 20-cent dollar, you're going to do it. That's how Buffett became wealthy, more or less, buying stocks, trading at 20, 30, 40% on the dollar. So that's the logical play in the nearer term. And then from there, I think you'll see they'll release a more of a banking type structure, which is borrowing and lending. They'll borrow and lend out their stack to get fixed yield on it, right? Something that is sustainable. And it'll become like a Bitcoin bank. And you probably get 5 or 10 of those. You'll get a lot of acquisitions. You get a ton more just collapsing. You'll get a lot of buyouts. Whatever, but the whole industry is going to change so much, and they'll be like, oh, see, look, the treasury company model worked, but really it's nothing like it is today. I mean, this is the best looking chart of all of them, and it's still just terrible, like disgusting. So yeah, we looked at some others before, but that's what I've got to say. MicroStrategy. I think that's all of them. The last question was, have you had a look at Bitcoin USDT dominance? Oh, I think I know what you're saying. Like stablecoin dominance. I haven't, let me just pull that up on another chart, just a second. This will be the last chart, I think, unless you have any other questions. Last chance. So I think you're saying, do I have it here? I do have it here somewhere, but let me also add USDT market cap. Yeah, this is quite interesting, definitely. Good one to raise. Try and make this look a bit better. And yeah, so why is this still looks terrible, but we'll have to deal with it. I'll first talk about stablecoin market cap, which is green. Well, it's USDT, so it's whatever 80% of it. Generally, make it log. There we go. It's a bit better. Generally, when it's gone up, it's been a sign of strength for the market, and when it's come down, which has been very short periods, it's been arguably been a risk off period because capital's leaving the system. So in prior cycles, people would just park their money in stables like Tether, more or less, to risk off. But then if they're like completely given up an industry, you literally will just get rid of your stables and pull it out of crypto and wire it to your bank because you don't even want to have anything to do with crypto, right? So we don't see that very often. We did see it also here. Literally, that's really interesting. There's a good confluence there with what I was talking about before. This is that May 22 period that looks similar to today. So before Bitcoin, yeah, this is actually a really great chart. Bitcoin was down 70%. Then we saw stables start to fall. So people were giving up on crypto and we went down another 50. And then the price cycle down 55%. People start to give up on crypto and we drop another 45%. I'm going to call that 30 because this was basically the FTX fraud. I mean, the whole thing is FTX selling user assets as well. So it's, you can't compare these things equally, but so where are we today? I mean, it's definitely much better than all of those scenarios, but yeah, it's just much better. It has come down a little bit, but I'd want to see it really turn lower to get any kind of concern on that because it's pretty flat. So that's okay, but it's something to monitor very closely. Then I think more to your point is this other chart here. So I'll just I'll hide that now. Yeah, so stablecoin dominance is a nice or interesting chart. Very roughly, you'll have seen something like this over the years. I'm drawing it very rough. I'll just keep it where it was for now. Anyway, the point is when it goes low, there's less USDT in the market, so it can be close to a market top because people have swapped their USDT into coins like Bitcoin and what have you. When it goes up, it means people have hedged a lot relatively, and you might have an opportunity. I can probably draw up a better chart of this later, but I need to get going, so I'm just going to keep this pretty rough. Anywhere in here, and then again, you could say here, right? So there's high USDT in the market, people have hedged, so you could argue we're close to the bottom. So I've said that pretty consistently, is that we're definitely closer to the bottom than the top, like by a long way. It's just timing that entry. I think, like I said, if you're confident on Bitcoin long term, if you think all these risks will be resolved, then it makes sense to have some allocation now. But if you want to manage drawdown, which could go more and could be measurable, then you might want to think about some of these things and size accordingly. And that's kind of where I land. So this is definitely promising, but even in the last cycle, USDT dominance spent a long time elevated. We've only really just come up. So great call out. I'll try and tweet something more detailed on that later, and it's a good one to watch. But thanks, guys. I'll wrap it up there. It's been a long stream, I believe, so been fun, and we'll catch you guys next time. Cheers.